All right, good morning, everyone. Let's begin. Hi, welcome. Well, I hope you had a nice vacation. A week off, we got a little bit of momentum and then we stopped, so it's going to be a little bit painful for us to get moving again, but that's all right. We'll power through. So let's take a look at some announcements. First of all, homework assignment number 3 is due now. You should set it on the chair at the front of the class. And your next homework assignment is called Interest Factors, and it's homework number 4. I put it on the table here, and it's a long assignment in terms of number of problems. But as you'll see from today's in-class exercise, you can solve these problems very quickly. You know, each one of them may only take 60 seconds to complete. Some of them are going to be longer than that, but some of them are very, very quick. So that assignment will be due a week from today on October 4th. And so what we're going to do today is we're going to continue in-class exercise 6. We were in a bit of a rush when we finished last time, and so I'd like for us to spend a bit more time on in-class exercise 6, and then we're going to start on the new material from chapter 2, which is interest factors. So what I'm going to do is, if you haven't already collected your in-class exercise 6 from the pile, you're going to need it, because we're going to spend a few minutes. I'll give you a few minutes of time to collaborate with your classmates, and then we'll look at the solution for that.
Did you give us the in-class exercise on Thursday too?
Let's take a quick look at the answers from the front side, and then I'm going to give you a little more time to do the back side of the paper. Okay, the first question just goes back to the idea of opportunity cost. And the definition of opportunity cost is what's the second best thing that you could be doing right now. Could be working, if that's the second best thing in economic terms, or if you're thinking more just in the enjoyment of your life, the second best thing would be sleeping right now, right? Or spending time at the beach, something like that. Okay, the second question is about credit rating. Now this is a real thing. This is real data. I didn't make this up. I took it from Bloomberg, which is a website that has a lot of corporate bond rating data. And there's different ways. There are these agencies that analyze companies and they rank them on how trustworthy the companies are. It's the strength of the company. And so a company that is rated AAA is the strongest company. And you'll notice a AAA company, like here in the 5-year AAA, they only pay 1.94% to borrow money. But a AA company has to pay a little more to borrow money for the same term. They have to pay 2.22%. And then a single A company is the lowest rating, at least on this table, and they would pay even a little bit more. So first of all, you have to identify for a 2, 5, 10, and 20 year what percentage they're going to pay, and so that's why I've starred that data here. And then you basically compare the rate of return that's listed to how much it costs them to borrow money. And what's the general rule for yes, do a project versus no, don't do a project? What's the criteria that we're going to apply here? Yep. Okay, so if a project returns more than it takes for you to borrow the money, then that's a good thing. If you're having to borrow money that's more expensive than the return you get, you shouldn't do the project. And so each of these, I'm just comparing the rate of return that it says to the cost of capital. And if the cost of capital is greater, then I say no. So updated computer hardware, okay, 2 years, 1%. How much does it cost them to borrow money for 2 years? It costs 1.3%. So they shouldn't do that project because this project B only gives them 1% return, but they paid 1.32% to borrow the money. So that would be losing money and doing work on top of it. So they shouldn't do that project, and so on. Any questions so far? Okay, number 3 isn't about calculations. It's just to get you thinking, why is one company rated AAA and another company is maybe rated AA? So those rating agencies will look at how much debt the company already has. The rating agencies will look at how many ongoing projects they have. If it's a company that doesn't yet have any customers, that's a bad sign. But if the company has plenty of customers and lots of orders in the book, then that's a very good sign, and it's going to help their rating. So it's just a reputation of the people who are running the company. The balance sheet means debts versus income. That's just some of the factors that they consider when they're rating a company. All right, the fourth thing is about the weighted average cost of capital. And different sources of income for borrowing have different interest rates associated with them. There's bonds, stocks, there is, in this case, a loan from a bank. And so they're getting a little bit of money from 3 different sources, and all of this is a weighted average. So it's a very straightforward thing to do the weighted average. All right, so now I'm going to turn you loose, turn over the back side of the paper if you haven't already, and take a look at this table. This is more real-world data. I got it from the NASDAQ Dubai website, and I'd like you to look at this. You've never seen this table before, but I want you to do some investigative work. Try and be a detective and interpret what some of the information means on this table. So the questions I've given you under the table are meant to sort of step you through the thinking process of trying to figure this data out. All right, let's talk about this table. This isn't stocks, this is bonds. And so bonds, remember, are a way for a company to raise money without giving a share of the company. Stocks, if you own a stock, you actually own a piece of the company. If you have a bond, you don't own a piece of the company. All you own is the company obligated to pay you back at a fixed interest rate. So question A, what do you think the given date refers to? The dates that are here. Any ideas on what the date, these are all future dates, and so what do you think it means? That's right, it's the maturity date. So the dates that are listed there is when the company has to pay back the bondholder, the original amount. So the way these bonds work is you give the company 100 dirhams, they pay you interest until the maturity date, and then on the maturity date, they give you back the original amount. So for example, the Agribank of China, when this bond was originally issued, to buy a bond, it was 100 dirhams. They would pay you 3.5% every, well, that's the annual interest rate, and most of the time it's a quarterly payment. And so they break up that 3.5% into 4 payments per year. And then on 11 September 2017, you get the original 100 dirhams back. Question? No, you only get the 100, the original amount. They pay you the interest periodically. So they're not keeping the interest and reinvesting it. They're giving it to the bondholders every quarter. Well, that's a good point. No, it's not compounded because in these you're not reinvesting the dividends naturally. They're giving the dividends back to the bondholder. So the payment is always just simple interest. Yes? The maturity date is when the original amount you paid comes back to you. Yes? Where's that? Where do you see that? I mean, this is a big table. I don't know. PRP? PRP? I don't know. It's a good question. I'll find out and I'll get back to you. Sometimes what it can mean is that the company has the option to pay off the bond early, and it might be that when it says PRP that it could be a bond that they're trying to pay off now. Like, look, this one was 2014, so it looks like it should already, I don't know. It's an interesting question. I'll find out and I'll get back to you on that. All right, so B, what does the last 3 letters of the code refer to? Here's the code. It looks like AGR is probably like an abbreviation for Agribank of China. Yeah, and that's right, it's currency. And so what's CNY? Chinese yuan, yeah, USD, dollars, GBP, Great British Pounds, EUR, Euro, NZD, New Zealand dollars for some reason. It's strange that Emirates Bank would be issuing a bond in New Zealand dollars, but there must be a demand down there. Okay, now here's question C is maybe the trickiest of all. Why is the price high when the percent is high? So let me explain a little bit more let me re-emphasize how this works. Originally, all of these bonds cost 100. That was their original price on the day that they were issued. But interest rates are always going up and down, and a company's creditworthiness may change from time to time. Let's just use, for example, DEWA. Well, that's not a good example. Let's use MR. If MR has a few projects that have a disaster, let's say that they have a building that is having lots of structural difficulties and there's maybe some controversy, how desirable do you think their bonds are going to be? Will people want their bonds? People won't necessarily think that their bonds are as good if the company is doing bad. And so on the secondary market, you don't have to hold your bond for the whole time. You could sell your bond to someone else if you need the money now. And usually these bonds, you're agreeing to hold on to their bond for 5 years or 10 years or 20 years, whatever the case may be, but you can always sell it to someone else and you don't have to wait for maturity. And so these prices here, it's the price on the secondary market if you wanted to sell the bond to someone else before it comes due. And so sometimes you'll see this 95. That's not necessarily because the company is doing bad. That could be one reason the price is low, but it could also be because the interest rate is low. And so if you are going to go to the secondary market where these bonds are being exchanged, you want the one with the highest interest, right? I mean, look on this list. I want the one that pays the highest amount. What's the highest amount you see? 8.5? I would love to get 8.5% interest, right? But you have to pay a lot for that. You have to pay 106 to get a bond that is paying a face interest rate of 8.5%. And so that's the main reason why these prices are high and low, like why they're not always 100 is you pay more for a bond that has a high interest rate and you pay less for one like 12%, right? That's a very high, but you're paying the most to get one that is 12%. And so what's the lowest price on this list? 92. That one might be because the company is doing poorly. Because 4.9, that's a pretty good interest rate. Yeah. It can be a factor, but it's not a huge factor because these interest rates are annual interest rates. And so maturity does, you wouldn't want to buy a bond that's maturing next year necessarily. That might make it less attractive. Yeah. Mm-hmm.
Why do people buy the second?
Yeah. Well, the original bonds are always 100, and maybe DP World isn't issuing any bonds today. They may only have a bond sale once every year or once every 3 years. And so you go to the secondary market just because there's a lot more variety there than like the straight original issues, which are only held every once in a while. And you go to the secondary market because maybe you can find a good deal. Maybe someone is trying to raise a lot of money, so they're selling their bonds at a lower price, at a discount, and you think it's you do the calculations and find that it's a good value for you today. All right, so date of maturity was the first one. The second one was currency. C, what I said is an investor must pay more to buy a bond that pays a high yield. And that's like the main factor at work there. Although I think we spotted a company that's probably in trouble because it has a high yield, but the price is low. So people must be less willing to buy this company, Alpha Star Holdings. It may look like it's having some trouble. All right. Part D is back to that idea of why does a single company have so many different interest rates? So Emirates NBD. If we look at Emirates NBD, they have some that are paying 1.75, some that are paying 3, some that are paying 4, 6. Bonds that are issued first are senior. And so like if a company goes bankrupt, the people who bought the bonds originally, like the earliest issued bonds, have seniority to the bonds that are issued later. And so part of the way that they get around that is by offering a higher interest rate to the bonds that are less senior, if it should come down to bankruptcy. And then the other thing about it is just, depending on how many projects a company has, it's that curve of, remember we looked at the curve that says the more you borrow, the more expensive it costs. So this is the percent interest, and this is the amount borrowed. So as you get more and more debt, it becomes more expensive to borrow money. That can be another factor. Okay, so that's in class exercise 6. You can hang on to that. We're not going to use it. I won't be collecting it again from you. Let's take a look at some of the new material. So we're working on in-class exercise 7, and I am going to collect in-class exercise 7 from you at the end of class. So we're going to be using some factors that you can get in your book. At the end of the book, past Appendix E, are factors that look similar to what I've included on the in-class exercise. So see these tables? This next couple of lectures is all about these tables. And so in problem 1 of this in-class exercise, what we're going to be doing is we're going to be finding an unknown future amount based on a known present value. So the statement says a person deposits $5,000 into an account which pays an interest rate of 8% per year. The amount in the account after 10 years is closest to what value? And there's 4 options there. This is similar to the format you'll face on the FE exam. Everybody here has to take the FE exam, right? That's a multiple choice test. That's either good or it's bad, right? Okay, so let's get used to multiple choice tests because you're going to be facing one pretty soon. The first thing to do in all of these problems is, if you can, make a cash flow diagram. Why is this line down? Outflows, when you're losing money or where you're paying it out, that's, the arrow is down if you're drawing it from your perspective. And the arrow is up when you are getting inflow. For these cash flow diagrams, let's make sure that we also write the interest rate somewhere. It doesn't have to be above the line, just somewhere in the vicinity. Represent the cash flow diagram. So let me talk you through how this works. What you do is you first interpret what is given and what is unknown. So here we want to find F given P. And so for the solution, I would write find F given P. And so that is F slash P. And then we look and see what's the interest rate, 8%. I equals 8%. And then we see how long it is, 10 years. So N equals 10. Go to the table, and we're going to use the 8% table, and find the column that says F slash P. It's the first column. F slash P, and we want to look up where N equals 10 for 8% table. What is the factor? F slash P is 2.1589. Okay? So we take that factor and we multiply it by the present amount. So to find F, F equals P times 2.1589. All right, so that gives you an idea of how all of these problems are going to work. All 4 of them, it's the same approach. Draw a cash flow diagram, set it up on what you're finding versus what is given. You write it like in the brackets like this. It's this sort of an abbreviation that you use to know which factor to look up. You find the factor and then solve for the unknown. That's the same pattern for all 4 problems. So I'm going to turn you loose to work on those. I'll be circulating around the classroom with the answers if you want to check along the way. Let's take a look at the solution just in case there's questions that we want to address. Okay, so the first one we've already talked about. That is find f given p. So you look up the factors, multiply it by the original amount. Answer C. Okay, question 2. In question 2, what's missing? What is this? That's weird. Okay. Question 2 is, by the way, in the homework I just gave you, sometimes they tell you a lot of details about the company, like it's a chemical engineer who's trying to develop a polymer. Just ignore all that stuff. That's just trying to distract you. All that matters in these is just drawing the cash flow diagram. The interest rate matters, the number of years matters, and the dollar amounts matters. So don't get worried when you see a really long problem statement, because it's just a bunch of nonsense details you don't have to take into account. We draw the cash flow diagram is the important thing. So we want to find what is the present value of $50,000 in 5 years, discounted at 10%. So it's find P given F, look it up in the table, and there's the factor. Multiply it by 50,000 and you get 31,045. Any questions about number 2? Annual series is where it gets a little more tricky, right? Okay, so let me discuss the pattern of an annual series is that there's nothing in year 0. So we have year 1, 2, 3, 4, and 5, and the same amount for all of those years, but there's no inflow in year 0, but we want to find what's the present amount of it. So the break even, how much should you spend now to have, basically you can think of it as a bank. How much do you put into the bank now to get this amount out of the bank every year and have nothing left at the end? So find P given A. So P slash A, I equals 10%, N equals 5. And there's the factor. What? How did I get which? Oh, the factor. Okay. So look in the table. This is the 10% table, so that's the lower one. P slash A column, so it's the present worth. And I go down to N equals 5, and there's 3.7908. All right. Are there other questions on the third one? Okay, and then the fourth one. This is a little bit weird because there's no downflow. There's no cash going out. There's only cash coming in. It said the way it describes here is that the company is going to save $10,000 per year. And so we want to know for the $10,000 a year it's going to save, what is the future amount that that's equivalent to in year 7? So this is find F, the future amount, given A, an annual series. F slash A. So you go to the F slash A column, 8%, down to N equals 7, and the factor is 8.9228. We multiply that by the original amount, and it should be 89,228. So answer C is the correct answer for number 4. Easy, right? Easy. You should get started on the homework today. Think about how good it would feel if you got halfway through this homework assignment before lunchtime. You could do it. It's just like easy little problems like this. I mean, it's a simple concept, but it's really powerful because there's a lot going on in the heart of these factors. It's compounding the interest for you. That compounding is built right in. All right, before we let go for today, let's take one last look at these announcements. You've submitted homework number 3. I'll get that to the grader and back to you as quickly as possible. Homework 4, you're going to solve half of those problems before lunch, and then the rest of them you'll do whenever you feel, probably, Friday night, Saturday night? Saturday night? Because you feel like, oh, I already got it done. No, but that's due Sunday the 4th, and I will see you on Tuesday. Have a good day.